Cool. What's up, guys? So in today's video, we're gonna go over a very important topic, which I do recommend you guys to pay very close attention to this topic. In today's lesson, we're gonna go over risk management in day trading. Now, the reason why I say that risk management is a very important topic is for a few reasons. You can have a strategy that can be a very good strategy, 80%, 90% win rate, right? But if you do not understand how to control your losses, how to prevent from losing way more money than what you guys are willing to risk, how to properly take a good RRR, which is risk to reward, then pretty much you're setting up yourself to failure, right? Risk management is what's going to protect your capital and what is going to make you guys way more money. So make sure you guys are paying close attention in this topic, and let's get right into it. So the question here is, what is risk management? So risk management in day trading is the process of identifying and controlling potential losses in every single trade. So make sure you guys are taking these type of notes. It helps you guys to decide how much of your capital you guys are willing to risk on each trade and how to minimize the chances of losing more than what you guys are willing to, right? So again, check this out. The most important keyword here is that it helps you how much to decide of your capital you're willing to risk on each trade and how to minimize, right? I would say the minimize will be the most important part. How to minimize the chances of losing more money than what you guys are willing to risk, right? Now check this out. Why is it important? First of all, it protects your capital. Second of all, it prevents from losing more money than what you guys are willing to risk. And the last one, which I will say is the most important part, which is help you keep your emotions on point. Let's go over the first one, which is protect your capital, right? So let's say you guys have an investment of $10,000, right? You guys are willing to invest $10,000 into the financial markets, right? Your goal in the market is not to lose or not to risk your full $10,000 in the market, right? Your goal is to protect your capital. That means that whatever trades you guys are willing to take, right, make sure that trade does make 100%. You're not going to be trading every single day just because you guys want to feel involved with trading, or maybe because you think that more time in the chart is going to make you guys more money or more successful. That's wrong. Again, your goal in trading is to protect your capital, meaning that you guys are only willing to look for trades or willing to risk trade that gives you guys an A to a B plus setup, right? This is exactly what I mean by protecting your capital. You're going to protect your capital. You're not going to give your money every single day to the market. You're only going to be taking trades that does make a lot of sense, that gives you guys a probability of an A to a B plus setup. The second one here is prevent from large losses, right? So check this out. Whenever you guys are taking a trade, right, you guys got to ask yourself a few questions. First of all, does this trade make sense? Is it an A or is it a B plus setup? The second one is, how much money am I willing to risk in this trade? I'm going to show you guys some system. Obviously in this video, I'm going to show you guys some system, some way that I personally do risk my money. As well, you guys can obviously apply this type of system into your own personal trading, right? But check this out. Prevent from large losses. Whenever you guys are entering a trade, right? Let's say you guys are entering these buy positions right over here. You're going to have a risk to reward ratio, right? Which I'm going to cover this up in this video. But a risk reward ratio pretty much is what you guys are willing to risk for the reward you guys are making or potentially can make, right? So let's say you guys are looking for a 1 to 2 risk to reward. You guys place your stop loss underneath these type of lows, right? Again, prevent from large losses. Here's the idea. A stop loss is very important for you guys to always place. The stop loss is pretty much if the market goes against you guys, it's going to take you guys out of the trade. And whatever you guys are willing to risk, let's say you guys were willing to risk 1% of that $10,000, right, which is going to be $100. If you guys are willing to risk that 1% of that $1,000, then pretty much you're going to lose $100 in this trade, right? Now, it prevents from large losses. Now, what does it mean by prevent from large losses? If you guys do not place a stop loss, right? If you guys are not placing a stop loss and the market just continues dropping, you guys are losing way more money than what you guys could have potentially lost, right? Your goal is to always risk around 1%, right? If you're not risking 1% or if you're not placing a stop loss, the market is just going to continue floating to the downside, and the more money that you guys are going to lose, meaning that the more money or the quicker is the way that you guys are pretty much going to flush away your account, right? So it prevents you guys from large losses. You guys are going to pretty much have a plan where my stop loss is going to be at and how much percentage of the risk am I willing to risk of my capital. Now, the third one over here, which I did say it is very important, right? Now, check this out. This is why it's very important. It helps you keep your emotions on point, right? Now, obviously, us as a human, right, we're all going to experience different type of emotion. Whenever it comes into trading, these type of emotion can actually ruin our trading career, our trading potential, right? Now, check this out. Emotion in trading, you're gonna have fear, you're gonna have greed, you're gonna have FOMO, you're gonna have selfish, you're gonna have so many different type of emotions, right? Now, the idea in trading is to not trade with emotion or to not let your emotion control you whenever it comes into trading. Now, the reason why is important, it helps you keep your emotion on point, is that once you guys understand risk management, once you guys have a game plan, a trade game plan, right? Then again, you're not gonna have emotion trading at this point because you have a game plan that is gonna tell you guys, okay, this is exactly how much I'm willing to risk. Now you consciously know that you are willing to risk that amount of money or the amount of percentage, right? Once you guys already have comfortable amount of percentage that you guys are willing to risk, this is your game plan right over here. Your emotions is not gonna be all over the places, right? So if let's say you guys lost a trade, you guys lost $100, boom, there's no emotion right there because again, that is part of your game plan, right? If you guys don't have a game plan, and let's say you guys are losing $100 and then another trade you lose another $200, etc., then that's what your emotions are gonna get into you. You're gonna have fear, you're gonna have FOMO, you're gonna have greed. You want to make back those losses, right? So again, it is very important to understand risk management. It is very important to have a game plan with risk management. So again, your emotions are always going to be on point. You're not willing to risk more money of your trade, and you're not having the fear, you're not having the FOMO, the greed to make back those losses. You have a game plan. Hey, I'm taking 2 trades a day. If I lose 2, I'm out of the day. If I win 1, I'm done for the day, right? So pretty much having a proper risk management game plan is what's going to help you guys prevent it from losses, protecting your capital, and the most important part is keeping your emotions on point. Now, why is risk management crucial in trading? So check this out. Consistency over time. It maintains a consistent profits while managing your losses, right? I'm going to explain to you guys obviously all of these steps in a few, but let me just read this out to you guys. The second one, protect against large losses. This is one of the most important part when it comes into risk management in day trading. Protecting from large losses. Proper risk management reduces the size of losses to the level, right? Check this out, to the level that won't wipe out your account, right? We're going to explain to you guys in this in a bit. Now check this out, prevent emotional decision. When you know your risk management is control, you're less likely to make impulsive decision due to fear or greed. Exactly what we were talking about in the previous slide. Again, emotional decisions, right? This is pretty much the emotion that you guys are going to fear or pretty much experience if you guys do not have a proper game plan with risk management. So let's go over the first one, which is consistency over time. Here are the key words, right? Consistent profit while managing your losses, right? So make sure you guys are taking down notes. Now let's go into the other one. All right, so here's the example of consistent profit while managing your losses, right? So let's say that you guys have an account size of $10,000. And out of those $10,000, you're willing to risk 1% of every single trade that you guys are taking, right? So 1% of $10,000 is going to equal to $100, right? Now, let's say that you guys take a total trade of 10 trades, right? 10 trades, right? Now, out of those 10 trades, let's say that you guys only won 4 trades, right? So here's what I really want you guys to pay very close attention, because this over here will pretty much be the game plan of every single trade that you guys are taking, right? So let's say out of those 10 trades that you guys took, right? Let's say that you guys only won 4 trades. Add a 2 to 3R risk to reward average, right? Now, I'm going to explain to you guys exactly how risk to reward ratio works in this video, but to give you guys an idea is that 2R, 3R is pretty much what you guys are going to be having the reward of what you guys are risking. So if you guys are risking 1%, obviously your goal is to make back double to triple of your investment, right? That's pretty much everything in general. You want to make obviously double or triple of what you're willing to risk, right? So if you're willing to risk 1%, your goal is to have a reward of 2% or 3%. Never want to have the same exact 1-on-1, right? You're willing to risk 1% to make back 1%. It's not going to be very crucial, right? Now check this out. Let's say out of those 4 trades, 2 trades hit a 2R, which is going to be $200 in profit. 2 trades. So now you're up $400 out of those 2 trades, right? Now let's say the other 2 trade, you did hit a 3R, which is going to be $300 in profit, right? So you're willing to risk $100 to make $300. You're willing to risk $100 to make $200. Now out of those 2 trades, you won 2 3Rs, which is going to be $600 in profit, right? Now if you guys do the math into this one right over here, your total win profit is going to be at $1,000, right? Now let's say you guys lost 6 trades out of those 10 trades that you guys took, right? Your total losses out of those 6 trades, because again, you're risking 1%, you're winning, you're losing pretty much $600 in profit. So in total profit, right, let's make this all the way down. In total profit, you're up $1,000, right? So let's write this down. 1K in profit, right? And then $600 negative, right? So we're in a negative and we're gonna have a checkpoint here. $600 negative. You guys do the math. Risking 1% of every single trade that you guys are taking, right? So you're risking 1%. In total profit, you made $1,000. The losses is $600, right? Now check this out. The net profit, again, $1,000 win, $600 in losses. Look where you guys ended for out of those 10 trades. Look at exactly all the profit you guys end up winning. At a $400 gain, exactly what you guys won. You guys lost $600 and you guys won $1,000. Risking 1%. Out of those 10 trades, you only won 4. Out of those 10 trades, you only lost 6, right? Again, you're still gonna end profitable, right? You're gonna still have a profit gain of $400 gains. So even though if you guys have a 40% win rate, you stay profitable. Why? Because again, your risk is controlled and your reward is multiplied, right? This is exactly what I explained to you guys this one. You're risking 1%, you have a control. Whenever you guys have a game plan, you guys have an emotion control, right? Which, like I was explaining to you guys in the previous slide. Once you guys have a game plan, your emotions not going to be all over the place. You do understand that you are risking 1%, right? So you are comfortable risking 1%. Now again, your reward is multiplied. This is where I tell you guys, never do a one-on-one. Always focusing on making back 2 to 3% of your investment. If you guys focus on making 2 to 3% of your investment, look at your wins and look at your losses. Yes, you did win 4 trades out of those 10 trades, and you did lose 6 trades out of those 10 trades. But again, you still became profitable because again, you're only risking 1%. You're multiplying your reward. So in total profit, you stay at a $400 gain. So this is why it's very important to have a game plan with risk management. Consistent profit over time while managing your risk. Now, going over the second one, protect against large losses. So proper risk management reduces the size of losses to the level that won't wipe out your account, right? So here is a key word, reduces the size of losses that it won't wipe out your account. So I'm going to give you guys the example. So here's the example. Check this out. Why proper risk management matter. So let's say you risk 1% per trade on a $10,000 account. Again, 1% of $10,000 equal $100. Now, even if you lose 10 trades in a row, your drawdown is only negative 10%. What is negative 10% of $10,000? Negative 10% of $10,000 equals to $1,000. So now your account balance, right? Let's put 1K. Now your account balance is going to be sitting at $9,000, right? Now check this out. Yes, you did lose negative 10%. Obviously, it's not the end of the world, but you did lose 10%. But here's the most important part. You're still in the game. You still have $9,000 in your trading capital. Meaning that with those $9,000, if you guys do have a proper risk management plan, you guys do find out good A plus, B plus setup, obviously you can make back that 10%, and again, you're still in the game. You haven't wiped out your account. Now this is what I have written down over here. Proper risk management reduces the size of the losses to the level that won't wipe out your account. Now, if you guys do not have a proper risk management plan, and you guys are not following the 1% risk, right? Again, this is where the emotion is going to get part into it. This is why emotion does play a big part when it comes into risk management and again, having a game plan. Now, imagine risking 10% per trade. Let's say you guys have $10,000 and then you guys have this mindset of, I want to get rich quick. I want to make a lot of money every single day, right? So let's say you're risking 10% of your account balance. You're risking $1,000 every single trade to potentially make $2,000, $3,000 in account, right? Yes, your reward obviously is going to be very high, but it's not the goal, right? Remember, it's not a get rich quick. You got to do it correctly. You got to do it consistency over time. Your account balance is going to grow over the time, meaning that the time that it continues growing, the more money you guys are able to make if you guys are following a proper risk management plan. Now check this out. Now imagine you're risking 10% of the account, which is going to be $1,000 per trade. Just 4 losses, right? It will cut your account in half from $10,000 all the way to $5,900, right? So just 4 losses, risking 10%, risking $1,000 per trade is going to cut your account balance in half. Right over here, I have written down, it won't wipe out your account balance. So if you have a proper risk management, it won't wipe out your account balance, right? So just only 4 trades you already have of the account. Over here, you took 10 trade, risking 1%. Check this out, you lost $1,000 and your account balance is still at $9,000. So you still have a lot of room to recover your losses. Over here, you only took 4 trades, which means that you're already down half of the account from $10,000 all the way to $5,000, right? Obviously, that is one of the worst risk management to ever do. Again, your goal is to understand risk management, stay in the game for the longest time, right? Like just like I have it over here, it's about staying in the game long enough to let your edge play out. So proper risk management reduces the size of the losses to the level that it won't wipe out your account, right? So this is exactly why risk management does matter. So this last one over here, like I said, the emotion part, which it does plays a very big part in trading, prevent emotional decision. When you know your risk is control, right? When you understand how much you're risking per trade, right? It's control. You're comfortable that you're risking 1% of every single trade that you guys are taking, right? You're less likely to make impulsive decision due to fear or due to greed. So once you guys understand that you're risking 1%, you're most likely to avoid making impulsive decision. Let's say you guys don't have a game plan. You guys lost, let's say out of the $10,000, you guys lost 10%, which is gonna be $1,000, right? Risking $1,000, right? Because you guys don't have a game plan and you guys are just willing to risk $1,000 because you guys have the mindset of that you guys want to get rich quick. You guys lost $1,000. Okay, this is the emotion that you guys are gonna fear. The emotion that you guys are gonna experience. You guys are gonna experience fear. You guys are gonna experience greed. What is fear? Oh shit, I'm gonna lose my account balance. What is greed? I gotta make back my losses, right? Again, you're gonna enter another trade, back to drawdown. You're losing another $1,000. So you went from $10,000 all the way to $8,000 quickly, right? Again, you're gonna have the fear because you're gonna keep losing more money. You're gonna have the greed because you wanna make back the losses. And it's gonna be a cycle. It continues, and it continues. And this is exactly why a lot of traders don't make it in this game, because they have the mindset that they want to get rich quick and not over the time. Again, the key word here with risk management is consistency over time. It's not a get rich quick. It is something that takes time, and it's something that does take time to master, right? So understanding why risk management is very crucial is, again, you are respecting your 1% rule, you're not disrespecting it, and you're not pretty much having the emotion controlling your trading, right? So this is exactly why risk management is crucial in trading. All right, so now we're going over risk to reward ratio. So this topic over here is not very hard to understand. It's actually very easy. And if you guys do apply it correctly, again, you guys are going to be very, very profitable in the long term with trading. So like I was explaining earlier, risk to reward ratio is like I have over here. It's how much you're willing to lose, which is going to be your risk, versus how much you hope to gain, which is going to be reward in a trade. So whatever you're risking, your goal is to make double to triple of your investment, right? So have that in mind. So going over the first one, which is a 101 risk to reward. So for every $100 that you guys are risking, you aim to make back $100, right? This is gonna be a 101. Me personally, I do not focus on closing my profit at a 101 risk to reward. That's not gonna be a very good trade. Now here's the reason why. You're risking $100 to make $100, right? So let's say I have this pen. I bought this pen for $100, right? And then I'm gonna sell it for $100. What is the profit there? There's no profit. You just make back your risk, right? So your goal is to always make back your 2%, 3%, which is gonna be double or triple of your account balance. Yes, you're making $100 extra, but you're not having profitable because you risk $100 and then you just made back your $100, right? So you're back at break even, right? So 101, me personally, every time that I'm at a 101 risk to reward in a trade, right? So let's say I'm in this trade over here, I'm at a 101 risk to reward. What I like to do is always go break even, right? Now, this is where pretty much emotion does play a big part whenever it comes into risk to reward ratio. And this is where I explained earlier, you cannot have an attachment with money. There's gonna be account balance, right? Let's say you guys have an account balance of over $50,000, $100,000, right? You're gonna see $1,000 in profit at a 101 risk to reward. Your goal is not to get attached to that $1,000. Yes, $1,000 is a lot of money, right? But again, your goal is to make back double of your investment, right? So again, the reason why 101 is not good, let's say that out of those $1,000 that you're risking, you make $1,000. Now let's say the next trade you lose $1,000. you're back at break even, right? And now let's say the other trade, you lose $1,000, right? You're down $1,000, but let's say the next trade, you won $1,000, right? Again, where is the profitable there? You're just going break even every single trade, right? Now, this is why I set my break even at a 101, and this is where demotion plays a big part, because you're gonna see that $1,000, but do not let demotion get into you. Just because you see $1,000 doesn't mean that, oh, I'm back at $1,000, right? Your goal is to make back double to triple of your investment, right? Now, a 1 or 2 risk to reward. So for every $100 that you guys are risking, you aim to make back a $200 in profit. Now, 1 or 2 is exactly where I will tell you guys, hey, you guys can focus on a 1 or 2, or you guys can focus on a 1 or 3 risk to reward. This one's over here makes way more sense than this one. So what is going to be the investment out of $1,000, right? Let's say you guys won at, you guys had a break even at $1,000, and then let's say your take profit is at a 1 or 2, which is $2,000. You're risking $1,000 to make back double, which is going to be $2,000. This is where we're talking a good risk to reward. So let's say that you guys lost one trade. You guys $1,000 on negative $1,000. Let's say you guys won another trade at a 1 or 2 risk to reward. You guys are at $2,000. Boom, you made back your loss, and then your profit back at $1,000. Now let's say the next trade you won another $2,000. You're now back in profit, 3K, right? And let's say the other one you lost $1,000. Boom, you're still at $2,000 in profit. You're still up 1% of your account balance, right? The next trade you won another $2,000. You're $4,000 in profit. The next trade you lose $1,000. You're back at $3,000, right? You see how over time you're actually seeing more profit than more losses, right? So this is why I tell you, focus on a 1 or 2 risk to reward. Same story goes on with a 1 or 3 risk to reward. Every $100 that you risk, you aim to make back $300. So you're risking $1,000 to make $3,000, right? That's pretty much why I tell you guys to always focus at a 1 or 2 to a 1 or 3 risk to reward. So like I was saying, at a 101 risk to reward, this is where I like to go break even. At a 1 or 2 risk to reward, there's going to be times where that I might have my take profit at a 1 or 2 risk to reward. But me personally, over the time, back testing my mechanic, back testing my strategy, etc., I've noticed that a 1 or 2 does play out half of the time, and a 1 or 3 as well plays out half of the time. I like to place my take profit always at a 1 or 3 risk to reward, right? But most of the time, sometimes it does hit at a 1 or 2 risk to reward. But let's say out of those times, I always have my take profit at 1 or 3, right? But at a 1 or 2 risk to reward, I like to secure half of my profits, right? So let's say I secure half of $1,000, right? Let's say at a 101, I'm at $1,000. At 1 or 2, I'm at $2,000, right? At a $2,000 in profit, I like to secure half. Boom, I secure $1,000. Pretty much, I secure pretty much what I'm willing to risk. So now I'm at break even. I did secure $1,000. Yes, I made $1,000. Now I have another $1,000 running risk free. Let's say if it hits my take profit, again, your take profit is gonna be out of 1 or 3 risk reward. So every $100 that you're risking, you're making back $300. I already secured $1,000 here, leaving another $1,000 running. So that means that my 1 or 3 is not gonna be a 1 or 2. So pretty much I'm gonna make $2,000 in profit if it does hit my take profit. Boom, I'm at $3,000, right? In profit for the day after risking 1%. So this is exactly where I do recommend you guys to do it. 101, always go break even. 1 or 2, risk secure half of your profits, or if you take profits out of 1 or 2, you guys can close your profit, full profit out of 1 or 2. And then 1 or 3, how I have it is pretty much my final take profit. So half out of 1 or 2, living it risk free. 1 or 3, if it hits my take profit, I do close out my trade completely. So this is exactly what risk to reward ratio is. Now to finish off this video, let's go over this one, which is how much should you risk per trade. So risk only 0.5 to 1% of your trading capital on each trade that you guys take. Me personally, I risk 0.5% if the trade is going to be in the middle, if it's going to be at a C plus trade, right? 0.5% if it's going to be a high risk trade. If it's a perfect trade, an A plus trade, then I'm going to go ahead and risk 1%. So let's say you guys are taking a risky setup. I do recommend you guys to only risk 0.5%. If you guys are taking a high quality setup, I do recommend you guys to only focus on 1%. So this ensures that even if you experience a losing streak, you won't lose too much money of your account balance. You're not blowing up your account balance. You're focusing on the 0.5 to 1% of your account balance. So example, if you have a $10,000 in your trading account, you're risking 1%, means that you're risking $100 per trade. So if your stop loss gets hit, you only lose $100 because again, you're following your 1% risk. If you guys win the next trade, you guys win $200 or $300, right? You made back your investment, you made back your loss, plus you ended in profit, right? And then obviously it just continues adding up over and over again. So why is it important? Small risk protect your account from large losses and allows you to trade longer. It allows you to stay in the game a long time. This strategy, right, this system is going to help your emotion control and encourage careful decision making. It's not going to help, it's going to help you guys from avoiding making impulsive decision, right? So that's pretty much it, guys, for this risk management video. Hope you guys really understand this video. Underneath the description, right, I'm going to leave down some system, right? I'm going to leave some PDF, the same exact system that I follow every single day to stay as consistent profitable in the market. I'm going to give you guys my trading game plan with risk management, so obviously you guys can apply it. Hope you guys enjoy, and I'll see you guys in the next one.